All right, how's it going, everyone? My name is Amos, and welcome back to another Roast My Portfolio episode. We are on number 6. Can you believe it? Anyways, a status update. Feeling a little bit better. Not exactly 100%. My voice is still gone. I have a headache. But hey, the show must go on. And today, we're going to be taking a look at Tyler's portfolio. And Tyler, he's 36 years old, and he's officially the equipment manager for the Seattle Seahawks. So not exactly the highest paying job for his background. Dude, he has a mechanical engineering degree, but it's his dream job. And that's what matters. What a handsome feller on the left right here. My gosh. Smile a little bit, man. Smile. And what you see on your screen right now is his portfolio. Let's go ahead and talk about it. So what is his portfolio goal? It's to hopefully retire early with his portfolio blowing up. He has holdings such as Adobe, Domino's Pizza, which I don't know why their logo is not represented, but I think that's kind of funny. But also United Health and Visa. And the strategy, how exactly is he going to retire early? Tyler's compiling a list of high dividend growth compounders that have a wide economic moat. So by finding businesses that have a really strong competitive advantage and they're the best in class in whatever it is that they do, he's hoping that the performance in the stock market will follow suit. And honestly, that logic makes a ton of sense. And something else to keep in mind is that his strategy and priority is to stay diversified across all the major sectors except real estate. He doesn't like the tax burden. And the game plan is to eventually switch to high yield income pairs as he gets closer to tapping out of the workforce, which as an equipment manager in the NFL, dude, I don't know. That seems like a dream job to me, man. And something else to keep in mind is that Tyler's got multiple brokerage accounts. He has a Roth IRA, he has a 401k, and he even has an OnlyFans account where he shows videos of his nasty ass feet. But in this video, we're going to be taking a look at only this, what you see on your screen right now, his taxable brokerage account. The valuation right now is $250,000, $256,000, and the portfolio's dividend yield is 1.9%. Let's go ahead and round up and say 2%, which means the annual income is about $4,900. And as you can see, about half of his portfolio is allocated towards 3 different funds, ETFs, SCHD, VIG, and BNY. This represents the international stocks. This represents the high dividend growth payers here in the US. And then the Vanguard Dividend Appreciation Index Fund is kind of like the blue chip companies that are high growth, but also happen to pay a dividend. But their dividend is kind of like throwing chump change. And the other half of Tyler's portfolio are the individual stocks, as you can see on your screen right now, like Mondelez, Schollenberger, Taiwan Semiconductor Manufacturing, and he also has Adobe. And he did make a note saying that Adobe does not fit his investment thesis, but he says that it's too good of a buying opportunity to pass up, and that's why they're a part of this portfolio. Adobe does not pay a dividend. So, after sitting with his portfolio, sick as a dog, on the couch and in my bed, I analyzed it and I thought about it, and here are my high-level thoughts and opinions, and of course we're going to go a little deeper later on. Number 1, I think this portfolio, it's a textbook example of a boglehead portfolio with Tyler's own spin to it. Because for a boglehead, I think in a perfect world, they would want like a 33% allocation towards like VTI, 33% towards an international ETF, and then 33% towards bonds. But in the case of Tyler, he doesn't have bonds, but instead he has about $10,000 into treasury bills. It's kind of like a high yield savings account. So I'm glad that he's not adopting the whole bond strategy. I don't really like it. So on a high level, when I think about Tyler's portfolio, I can tell as Tyler constructed his portfolio, he was really methodical. He applied science to the whole aspect of how to make the ideal and the perfect portfolio. It's a very systematic approach. And I think before I go any further, I just want to say this disclaimer. I think that's what makes all of this fun, right? There's no wrong answer when it comes to investing into stocks, unless you're going 100% YOLO into calls and puts, into the most speculative crap on the stock market. Then I disagree. But for some of us, we go all in REITs and BDCs. For others, it's Microsoft, Google. They don't even go near dividend payers. And then in the example of Tyler, he's pretty much balanced across the board. He's got his bases covered. And I think that's why personal finance, it's personal preferences. It really depends on who you are as an individual, your goals, your timeline, and especially your risk profile. I can talk all day long about why I like SCHD, but for someone who has a high risk tolerance, they're going to want nothing of it. It's going to go in through his ear and come out through his booty hole because he does not care about a safe and steady. If it's not going to 10x his money in the next 365 days, he doesn't care. So it really depends on who you are. And I want to caveat that by saying when I first started investing into the stock market back in 2019, end of 2018, I had a similar approach to Tyler. So that's why as I see his portfolio, it brings back fond memories because as I was taking classes for my MBA, I purposefully took classes, advanced curriculum about the stock market and especially about financial engineering and how to analyze a company and how to forecast their price and all of that jazz. And so through a textbook example of how you want to cover all your bases by exposing yourself to all of the various sectors, I think my MBA professors would probably really like Tyler's portfolio. And I mean, obviously, it skews heavy towards the tech space. About a quarter of his portfolio is allocated towards big tech, but it makes sense. Tyler's 36, right? He's got time on his side. But going back to my story, when I started investing into the stock market, I was really systematic. Meaning I didn't want any category being too big and making everything else small. So I had about like 1 or 2 stocks in every category. And I think at the time it was like Microsoft and Apple for my tech exposure. And then I had 2 stocks for the healthcare space, 2 stocks for the financials, 2 stocks for the REITs, and so forth and so forth. But obviously, if you're a member of the Patreon and you know what my portfolio looks like, I don't follow that philosophy anymore. Now I just go with what works. I just go with the flow. I invest into winners and I just try to keep it simple. Right now, I have 0 exposure to the pharmaceuticals. I have 0 exposure to energy. And for me, that's absolutely okay. Whereas like 6 years ago, dude, my head would have been spinning. I would have been like, hold on, my portfolio is not diversified enough. And that's because the reason why I changed my mentality is as I started to look at the successful investors in the stock market, like the hedge funds and the super investors, and I took a look at their portfolios, that's what they do as well. They go all out into concentrated holdings that they believe to be the winners. They don't care if they do not have exposure to XYZ sector. They go into what they believe is undervalued and can compound the next 2 to 3 to 4 years. Now, obviously, you and I, the amateur investor, the retail investor, I would argue that staying diversified is a great idea to hedge against risk, but also protect yourself from ignorance because it's impossible to stay up to date on all the various sectors and industries. There's thousands of publicly traded stocks in the stock market. So if you're not sure what's going to work, then to do a little bit of everything with like VU or VTI, I think you're good to go. And I would say that's true for about 99% of us. And that's not financial advice. That's just what I think. For most people, just invest into an ETF, call it a day. You have no business trying to pick and analyze individual stocks. But for the crazy and the delusional people like me, who like to outperform the market by investing into the winners within VU and SCHD, now even though my risk tolerance is really low, I like my risk to reward ratio by trying my best to pick the individual winners within VU rather than investing into everyone within VU. The winners alongside with the losers, and then your average return is like 10 or 11%. Instead of that, I would rather get the 20, 30, 40%, if that makes sense. But that was a really long-winded way to say, I'm gonna go ahead and evaluate Tyler's portfolio based on the criteria that is relevant and specific to his style. I'm not going to force my methodology or style onto someone else because I'm sure Tyler would disagree with my investing philosophy as well. But if that said, all things considered, I like it. I think half of the portfolio allocated to ETFs that covers all his bases, it's done on purpose, right? And it makes a lot of sense. I like it. Because when you think about it, if half of your portfolio is allocated towards these winning ETFs, like dude, if we're gonna be honest, SCHD, VIG, and an international exposure fund, you put those 3 together, you're gonna do fine. That means with your other 50%, you can kind of quote unquote gamble, take a risk. So I can see the mentality and the perspective, and I think it makes a lot of sense. So the funds are the main course of this portfolio, and the individual stock picks like Alphabet, Lind Group, Mondelez, those are the cherries on top, where Tyler can choose to be flexible. He can add, he can cut, but his funds, that's the bread and butter, and I like it. I'm going to be honest, I like it. Now, would I do it myself? No, but I like it. It makes a lot of sense for Tyler. Now, even though I think this portfolio and the strategy itself makes a lot of sense, to be quite frank, I do not know if it's going to outperform. Meaning, I think it's going to match the market's return step by step, maybe like underperform a little bit or overperform by the tiniest margin, but I don't think it's ever going to fluctuate one way or the other for what it's worth based on what I can see. And I want to take a time out to say that's okay. Not every single investor and portfolio and holding has to be a home run and get like a 50% ROI in a single year. For some of us, we would prefer the safe and steady modest gains path because that's good. Because a 10% is so much better than getting a 2 or 3%, which happens to be the harsh reality for most people's portfolios. Because believe it or not, there's people out here where their CAGR for the portfolio, it's probably like a 2, 3, or 4%. So to get a modest 10% year over year with this portfolio, I'm pretty sure Tyler is more than happy. And that's why I'm saying it makes fundamental sense. I like it. Now, transitioning over to the portfolio scorecard, we're going to be giving Tyler's portfolio a grade and a rating based on 4 criteria metrics. The first one is going to be the asset and strategy fit. Like, do the position holdings make sense for their portfolio's goal? Overall, bottom line up front, I'm going to go ahead and say it's a B+. I think it's above average. It's really good. And even though Tyler and I didn't go on a coffee date where he talked for like 50 minutes telling me about his portfolio strategy, I think by looking at it, it makes a lot of sense, right? I understand why he has so much allocated towards VIG and SCHD, why it makes up such a big allocation for the 50% of his funds segment. Because one has a juicy dividend yield and excellent dividend growth rate of about 10 to 11% year over year, whereas the other one has really high quality holdings in the portfolio with a less than desirable dividend profile. But nonetheless, with VIG, you get better share price appreciation. So I think that more than makes up for the fact that their dividend profile is not as good as SCHD. However, with that said, I would argue, like if I was articulating my case to the MBA professor about this portfolio, I would go ahead and leave alone the international fund. However, I would swap out VIG for SCHG, if that makes sense. So SCHD, SCHG, and the international fund. One will cover your basis for the dividend yield and dividend growth rate. One will cover your basis for China, Europe, the emerging markets. And the last one will cover your base with the growth. Because pound for pound, I would argue one of the best growth-oriented diversified ETFs out there is SCHD. However, being two distinct dividend ETFs, VIG and SCHD, I do think they make a good partnership because there's very little overlap. You would think because they're dividend ETFs, it's going to look one for one. Absolutely not. Because if you look at the holdings for SCHD, it has a lot of telecom, energy, and pharma stocks, whereas VIG has all of the blue chip names like Broadcom, JP Morgan Chase, Apple, Visa, MasterCard, Johnson & Johnson, Walmart. So I think it complements one another. And in regards for the individual stock picks, I understand the logic of trying to cover your bases across all the sectors to diversify away your risk and to reap the rewards when one sector outperforms or when the rotation happens. Like, I get the logic, similar to how you also like to avoid REITs because of the tax treatment. However, I'm not exactly in love with the decision to add the oil and gas Schellenberger and the chemical processor Lind Group, which are recent calls as you alluded to. I think you were better off without those two because as I looked at their financials, come to find out, absolutely cyclical. Their financial success has ebbs and flows. Sometimes it's up, sometimes it's down. It really depends on the market cycle. Because I think one of the primary characteristic traits of a dividend compounder with cheese is a business operation that can consistently and reliably increase their financials year after year without fail. So when I think about Microsoft, Google, Salesforce, they're increasing their top line and their bottom line and their free cash flow consistently. But when we think about the oil and gas players, it's boom and bust. When we think about chemical companies like Dow or the Lind Group, it has highs and lows depending on the market's demand and the various stakeholders that are using their products. And so I think that might beg the question that why didn't Tyler get an A or even an S? Because if the name of the game is representing all of the sectors except REITs, I would argue the utility space is really light. I mean, I love that you added American Waterworks because I think they're probably pound for pound one of the best utility stocks out here. But if the name of the game is having your sectors balanced and represented, it does skew heavy for the tech space. I personally think it makes sense and I like it. But if we're going to go off that principle of having your sectors represented and diversified, it is really heavy in certain sectors and really light in the others. But with that said, you didn't ask for this, but I would continue not giving the telecom sector any love. When we think about AT&T, Verizon, Charter, those ones right there. And then, of course, this is nitpicking, but as we just talked about, the mix of funds, I like VIG, but SCHD in lieu of it would be better. But I will say this, Tyler, at least you're not a hardcore boglehead. Those guys, they tend to piss me off with their philosophy on how dividends are disgusting and it's a taxable event, and they like to make the generalized statement that a dividend means a company is done growing. It makes my head explode and it makes me want to lactate. Just irritating. And here's a funny thing about the bogleheads. They believe this portfolio strategy, okay, that the bond allocation should be equal to your age. So since Tyler is 36, a true follower of the boglehead philosophy would put 36% of his portfolio towards bonds. And so if you're like 65% of your portfolio should be allocated towards bonds. And dude, that's just, don't even get me started. But I don't want to come off like a hater because I think the boglehead philosophy makes a ton of sense for the hands-off investor that does not want to spend day in, day out, or week after week researching and looking at stocks, right? Just VTI, call it a day. I agree with them on that end. But my goodness, do I disagree with a ton of their tenets and strategy. Because just like Tyler, whenever I do have cash, I don't put it into bonds. Instead, I put my cash into a money market fund or high yield savings account until it's ready to be deployed. I used to buy bonds back in 2018, 2019, and then I realized how it just does not make sense for me anymore. And in terms of the level of risk, to be honest with you, this portfolio, it doesn't take a rocket scientist to see that it's moderately safe. I would argue 3 out of 10. There's not a single speculative stock that I do not like here except perhaps, I know this is going to be unpopular, Adobe. I think Adobe is absolutely high quality. I love their financials. Their growth story is still growing. Everyone seems to be bearish, and the market disagrees with me. I like Adobe, but if we had to nitpick and be really strict, I think he really doesn't make sense for your portfolio. But I'm going to go on record by saying I think Adobe is undervalued. The market disagrees, though. And in terms of the quality of holdings, do they have an economic moat? Are they dividend compounders? Are the fundamentals sound? I'm going to say A-. For the most part, out of his 13 individual stocks, I like most of them. I can resonate with the logic here as he carefully curated and picked which ones to put into his portfolio. However, with that said, I do not like Lind. I do not like Schollenberger, and I feel worried for Booking with Google chipping away at their economic moat because for the most part, I think Google is now able to do the exact same thing that Booking is able to do to help these niche hotels and motels all around the world to have people book a flight or to book a room with your establishment. So I think it's only a matter of time before Google eats their lunch, but for the time being, Booking's numbers look pretty good. And you have Google in your portfolio already, so it doesn't really matter. I look at Booking the same way that I look at DoorDash or even Uber Eats. There's a ton of ma and pa restaurants here in the US. They don't even know how to make a website, let alone allow digital ordering. And so there comes in DoorDash or Uber Eats. They open up their restaurant to a bigger customer base because now they can order online or digitally. Likewise with Booking, it helps all these hotels, flights, buses, and trains to be in one ecosystem, one-stop shop. However, for the past, this is personal, okay? For the past like 6 or 8 years, I think 8 years, I've booked all my flights through Google Flights. Same with the hotels and everything. I used to book through Kayak, Expedia, Booking. I don't use those websites anymore. And maybe I'm missing out by not utilizing a website that is dedicated towards that purpose. But I'm sure that the younger generation is probably similar to me. If Google hasn't integrated into Google search and you're trying to find a flight to Chicago or Detroit, you're probably just going to go ahead and go with what's convenient, what's on your face, what's on your screen. And I think this goes without saying, but let's go ahead and do criteria number 4, the dividend sustainability. Do I see the dividends of this portfolio being reliable? To be honest with you, I do not see any potential dividend cutter in here. Every single one of these companies, at least for the next year, they should be solid and good to go. I looked at all of their dividend profiles, and every single one of their dividend payouts are healthy and sustainable. And now let's go a little deeper into the constructive criticism for this portfolio. What would I do differently if I had to improve Tyler's portfolio as an MBA case study assignment? Now, number 1, I think in your retirement tax-free accounts, your 401k, your Roth IRA, it's probably already allocated towards a total market or an S&P 500 ETF, mutual fund, whatever, right? So I'd rather want to see that taxable account to look and feel a little different than adopt the exact same strategy across all accounts, right? Just my cup of urine. I think doing the exact same strategy across all the different accounts, it's kind of like redundant. And I suppose if you're married to the idea of having a specific allotment by asset class and sector exposure, then so be it. I think you're on the right track and path, safe and steady. I don't think this portfolio is ever going to outperform, but it should be a reliable compounder. And here's a trigger warning. For me, I think diversification for diversification's sake, it often leads to diversification. And I think that's the biggest reason as to why I stopped trying to have exposure to every single industry and global market. Because even though you do cover all of your bases, it just overcomplicates things. That's why I'm personally not interested in investing into Africa, South America. I'd rather just focus on the businesses and compounders that make sense for me, and I'm okay with missing out on the hyper growth of India or China and whatnot. I'm okay with that. And the thing is, Tyler, I think 36 is pretty darn young. We're practically the same age. So having said all of that, I would double down on the fund strategy that you've got going on with the 401k and the IRA, but I would use the individual account for compounders only. Because when you look at the S&P 500, I can pull it up right here. I would argue VU is a proxy for the S&P 500. If we jump on over to the holdings tab, when we look at the top 10 holdings, they are responsible for nearly all of the gains in the stock market. Because if I scroll all the way down and we take a look at the bottom of the S&P 500, usually the losers, the ones that are kind of lagging and the ones that are weighing down the team. Think about Caesars Entertainment, Mohawk, Fox Corporation. These ones, not so cute, right? So I would argue for the individual taxable account, I think you're on the right track and path. The winners, it's not as hard as some people would like to say. I mean, it's right there in your face, right? If you click on any one of the top 20 or 25, they've all been doing pretty darn well in this year. And I think that's another video I really need to do, like taking the top 10 holdings of the S&P 500 versus the S&P 500 itself, benchmarking it and seeing the performance year over year. I would argue the top 10 probably outperform 2-to-1 or maybe even like 3-to-1. But regardless, with the individual taxable account, find and invest into the winners of the stock market. I think you're doing good. I don't like the idea of trying to cover all your bases and then putting Lindgren and Schellenberger. Obviously, that just happened recently, so maybe something skewed you towards that decision-making process. But whatever you were doing prior to that, I think you were on the right track. However, if you're going to go down that path, you got to make sure that it's a winner. And what I mean by that is, let's just go ahead and click on Microsoft as an example. Make sure that there's no blemish across their financials. Their revenue, their gross sales year over year, I mean, this is magnificent, right? Like absolutely a compounder. And it's reflected in their stock price as well. You look at their net income, which is the bottom line, for crying out loud, $100 billion of profits. Absolutely insane. You take a look at their balance sheet, $94 billion of cash on hand. Jump on over to their cash flow statement. It's probably just as beautiful. Their free cash flow, $71 billion. So I think you're on the right path by having Microsoft, Google, Visa, United Health in the portfolio. And then, of course, like 5 years out from retirement, make the slow pivot towards the high yield payers. I think you're already going to do that. But on the other hand, if Tyler's risk tolerance is really, really low, then I think this methodology and strategy makes a lot of sense. Because I'm going to tell you this right now, if you do go down the path of the individual stocks, it takes a lot of time to stay up to date to their earnings, to be informed of the ins and outs of the company so you know when to sell or when to buy more. So this strategy right here, having about 50% of the portfolio allocated towards funds, I think it makes a lot of sense. He's sacrificing a little bit of the upside, but in return, he gets a lot of stability and peace of mind. So to me, I think that trade-off is not bad at all. In fact, I'll go on record by saying it again. I think most people are better off by just investing into VIG or VTI and calling it a day. That's not financial advice, but they're better off just getting the market's returns and then just being happy with that. Because when you think about it, SCHD and VIG and the international fund, they do all of the screening for quality companies for him. They do all of the legwork, the hard work to figure out who goes in and who goes out. And it gives them diversification across all the sectors, industries, and global markets, right? So even if this was 100% allocation and it's split by those three, I would still bless off on it and be like, yeah, it makes sense. Personally, not for me, but it makes a lot of sense. Because in the worst case scenario, somebody that has only individual stocks in his portfolio, dude, that individual stock could face some really harsh storms, headwinds, and go belly up through bankruptcy, right? Then you lose all your money. But with SCHD or VIG, not gonna happen. Obviously, it could statistically, but not gonna happen. Now, with that, I want to give you my final remarks. I think after looking at your portfolio for the past 3 days, Tyler, I think I would think twice about Mondelez International. They're basically the parent company of Chips Ahoy, Oreos, and all those different cookies and biscuits in the grocery aisles because I do not know if they're a compounder. Realistically, even if you compare them to their peers in the same space, I don't know if they're going to be able to outperform them, let alone the market itself. I would think twice about Mondelez, and I would increase your exposure to the utility sector as a proxy for a bond. I think you're on the right track with American Water Works. Water bills, never going away. We're always going to shower. We're always going to need to flush our dookie. It's always going to be a necessity. I think the water utilities are really good, but then again, it might go against your strategy of only trying to have compounders in the portfolio and family, in which case, disregard everything. Because I don't want my MBA professor to give me a straight F by disregarding the portfolio's strategy. So all that to say, how do you think I did on this MBA case study assignment? If you were the TA, the teacher's assistant, and you're helping the professor grade how I evaluated and assessed this portfolio, what do you think? Do you like Tyler's strategy? Do you hate it? What critiques would you give? And if you want your portfolio roasted, you can submit it through the Google Forms link. It'll be in the pinned comment and in the video description itself. With that, dude, I need to sit down. I don't feel so well. I love you guys. Stay safe. Good luck in the stock market, and I will talk to you next time. Peace.